Hello, good afternoon. You're tuned into Closing Trades on 80 now. I'm Anisha Jain. With me is Aisha Faridi, and the color on the screen of the hues today have turned red again because during the trading session we had seen a bout of green. But no, that got sold off. The joke on the street is that the design of the Nifty today is mimicking the Trump Tower, because the sudden rise that we saw at Nifty and the sudden fall is something that the market is really watching out for, and that's because the volatility has spiked. Yes, it's a usual phenomenon ahead of the budget, but overall we have seen the India VIX spiking to 6-month high level. 17 is where the India VIX is right now, and that is something the market is really watching out for. Bank Nifty, that one is under acute pressure as we speak. There's a dip of 600 points. It's recovered from the lows of the day for what it's worth, but definite pressure there. It's SBI, HDFC Bank, ICICI Bank. They're all tumbling away in the trading session, and even from the frontline index, the haloed stocks that like Trent, it's down around 5%. Adani Ports is under pressure, and even a lot of earnings reaction of good quality numbers is getting punished today. So a Dixon Tech is down 13%. Zomato is coming under acute pressure. You also have India Cements, which has suddenly taken a dip of around 8%. Oberoi Realty, MCX, and the list really goes on today, Aisha. There are a lot more reds in that larger mid-cap category which are under pressure today.
Yeah, and I think today is really smacking of the pain that you're seeing at or rather feeling at an individual portfolio level. And it's kind of a rude reminder that when you have over-concentrated or overcrowded trades, even slight bit of a disappointment can really bring about a huge fall. Case in point, like you were pointing out, Dixon, 14% lower and still counting down. Zomato hasn't seen any recovery, irrespective of those block deals that happened, still lower by 10.25%. Some of the other key names, look at an MCX, that's down about almost 8%. There's Oberoi Realty, which is down about almost 8%. Trent has now breached even 5,800, so that stock is bleeding quite a fair bit. ICICI Bank is down 3%, almost just about defending that 1,200 rupee per share mark. As we speak right now, there's NTPC, Reliance, M&M, SBI. So today you're really seeing quite a bit of positions getting unloaded. Other than that, of course, there are those few spots of green as well, NLTF, Poonawalla FinCorp, HPCL, Apollo Hospitals, etc. But again, smacking off a little bit of a defensive tilt, plus, of course, earnings surprise as well. But let's take it across to our chartists and figure out what is it that's happening in the market right now. Kunal, more than this 190-point decline, help us analyze the VIX charts. And what's that telling you, whether there's further volatility or weakness in store for us?
I think the VIX generally, will rise, and I think I would not be surprised that over the next few days, just prior to the budget, we actually see 18 to 18.5 also on the India VIX, because that's a natural course of the movement for the India VIX just prior to a big event like the Union Budget. So I think we could probably be in for some bit of more rise on the India VIX. But then I think eventually what we have to look out for is that whether the indices get back into a break of a major trading range even with the rise of the VIX. So today the volatility is very high, but we've not broken below the critical support of 23,000, 2350, which we've hit I think last 4-5 days back for the index, and neither on the upside like when we were yesterday onto a fine trading day. We've not breached above the resistance positions of 23,500 for the index. So when you are trading into a very strong consolidative band, even with a rising VIX, that generally is an indication that the markets are just about digesting the volatility, remaining into a range, and assuming if 23,000 levels don't breach, we could probably be coming back into a bit of a bounce back mode over the next few days.
Bounce back, that's much needed, but for now some of the technical experts are telling us that 22,800 could be the next level on the downside if we go below that 23,047 mark, which Kunal was just pointing out. Naresh, what's the sense on Bank Nifty and some of these large caps, HDFC Bank, ICICI Bank, SBI, they're coming under quite a bit of pressure.
So the move which happened yesterday post Kotak Bank numbers has been totally taken out. We are back to the same price where we were a day before. And we keep seeing rotation in terms of stocks weakening. So we had IndusInd earlier breakdown, then Axis broke down. Today it is ICICI Bank, which is hitting a 2.5-3% downtick. So the struggle continues for now. 49,500 remains the most important point for Bank Nifty. Only when we start sustaining above those levels, we call a reversal. For now, the pressure continues. We are oversold on Bank Nifty as well as Nifty. So closer to 22,800, 23,000 should be a support going forward. And similarly, around closer to 47,000 odd levels, so 47,500, 48,000 on the Bank Nifty. So for now, we wait and watch. There is a lot of volatility today, being the Sensex expiry, and we've seen wild moves on the Nifty plus 250, minus 250, almost a 700, 800 pointed range in the day. So for now, we wait out for tomorrow, and then we see how the price action is.
Okay, we'll wait out for tomorrow and the price action because today has been fairly volatile. Devin Choksi also joins us on the show right now. Devin, the point that Aisha was making, it's a portfolio which is bleeding today because quality names that were part of many portfolio are getting undone. What should one do? Sell out of some of these names and book whatever profits you have, or just ride it out? Some of these names like Dixon, Zomato might have a good future when you look at the medium term horizon. Devin, I can't hear you. You'll have to unmute yourself.
Yeah, good afternoon, Anisha. Well, I think we have always maintained that companies, consumer tech companies like Zomato, or even EMS companies who are into the manufacturing of the consumer durables like Dixon, they are all fantastic companies. They have got a good business visibility too. However, everything is built into the price, and the price is basically discounting the future, at least I think, if not more, 2.5 to 3 years ahead of time. Now, if you are basically going to pay the price today for the performance of the company, which is going to come in 3 years from now, certainly, I think on a quarterly to quarterly basis, I think whenever you review the performance of the company, any small disappointment, I think, would probably cause a big amount of damage to the price, as we are seeing in both these companies. In my viewpoint, nothing wrong with the businesses, but the fact is that I think these companies can underperform big time if they are expensively traded and continue to be bought expensive. So, in my viewpoint, I would not be very keen to buy them unless I think a meaningful valuation correction takes place into these companies.
Interesting. So, at what level, Devin, would you say that Zomato becomes a buy? And what valuations would you be comfortable ascribing to the stock, given that the management itself is talking about almost a year or over kind of losses in the quick commerce business?
So, Aisha, I think generally, I think the rule applied here is, and that is a basic rule that we apply, that as much as the growth of the company is, I think if that particular premium is given to the future valuation, then it is justified. Here in these cases, I think some of these companies are actually traded at higher than the growth. It is, I think, 5 to 6 times growth valuations in many cases. So, in my viewpoint, I think that is a problem. Unless and until that gets rationalized. Now, either the rationalization can happen through price correction, or normally it happens that I think some of these companies would have a longer time correction. And that time correction can frustrate investors as far as the return is concerned. So I would always believe that I think as long as the growth is given a premium, that is justified. But I think that too in a rational manner for 1 year or so. If you give 3 years in advance, certainly I think there is no justification on that particular as well.
Right, interesting. That's the take on Zomato. Kunal, what about the charts on both Dixon and Zomato? How much more selling could one see?
Yeah, I would believe that after such kind of a sharp selling, gap down opening and the high volume candlesticks, what we've seen today as well as yesterday for both of these names, this could probably be an indication that the selling could probably intensify over the next few weeks. And ideally, we've seen that when stocks open with a sharp gap down, in this case for Zomato, it's broken below the 200-day moving average also. I would probably believe that there should be at least another 5 to 10% selling into the stock price further from today's low. So I think closer to 207.8 was the low for Zomato. I would probably expect the stock to come back to at least 188 to 195 kind of a territory. That's where one could probably look to maybe go for a buy on dips. The same could be attributed to Dixon. The stock, which has fallen by a margin of almost 11% today, has come back to almost 15,160 mark. It's still trading much above its long-term moving averages, but I believe that eventually the stock should retrace back to those levels. That's closer to almost 13,000, 13,500 mark for Dixon.
Okay, so that's the take on Dixon. Maybe 5% lower thereabouts is when the buying would emerge. But Devin, what about some of these hospital names? Apollo Hospitals, Max Healthcare, they're holding to the green in an otherwise weak market. Would you buy any of these names, or they still look very expensive to you?
They are all expensive. I think the same argument goes to, I think, these companies as well. Though I agree that I think this is one sector where larger amount of investors interested, and I think some of the large investors are putting money behind these companies, so that I think that money can also get used for the purpose of expanding the new rooms capacity that these hospitals are talking about. So that is justified. I think they are basically putting money behind the growth. But if you are to buy a fresh and if you are a minority shareholder, certainly I think you are buying very expensive proposition. I don't know, I think, how much time and price correction this particular companies can give, but the fact remains that I think they're expensive. So I think buying them at this expensive level could possibly invite for a larger amount of underperformance in your portfolio.
Right, okay, let's take a very quick break on that note. The fall still hasn't been arrested, so it's going to be quite the critical next lap of trading. We'll continue after this short break. Back with closing trades, and quite a bit of bleeding is what you're seeing at an index level, not just index level, individual portfolio level. And let me not even talk about what's happening within individual sectors, because that's going to give you a clearer picture of the kind of, clobbering that you're seeing in the markets right now. Look at the new age stocks. Look at what's happening within the realty index, cap goods, telecom, infrastructure, power, banks, technology. Pick up any sector and you're seeing very, very sharp cuts over there. But let's try and understand, how this entire jigsaw is going to play out, what Trump 2.0 is going to mean for the dollar and the world, and of course, emerging markets, much like India as well in particular. Mark Faber, editor and publisher of the Gloom, Boom and Doom report, joins in on the show right now. Mark, great to have you today on ET Now. Thank you so much for your time. Firstly, just wanting to understand what Trump 2.0 regime is going to mean for the US dollar and whether it's going to continue its upcycle.
Well, that's a very good question, because I think that the widespread optimism about the Trump second regime is misplaced. I think the dollar will weaken because he will spend as much as the previous governments. They will not cut the deficit much. Most likely, the deficit will increase under Trump. And so I think that money printing will be again accelerating, and that it will weaken the US dollar, certainly against precious metals. Yeah. And so I'm not very positive about the US, and a weak dollar would be welcome by European stock markets and by emerging markets.
Okay, by emerging markets. But when we were speaking a few months ago, Mark, you talked about how everything looks to be in a bubble. Has a lot of that corrected now, at least in the Indian markets? Because we have seen a correction of what, 10-12% from tops?
Yes, the damage caused in India is considerable because the index is holding up reasonably well, whereas the typical stock is down 20 to 30% already. So actually the indices don't reflect the reality of the damage. The damage is much more considerable. I've seen a chart about various sectors. Many sectors are down 30%.
So after the 30% correction, Mark, is anything getting into the buy zone now? Any sector that you think in India might just look relatively attractive?
I think the problem is I see many stocks in the world that are reasonably priced, also in Latin America and in Europe. But I think once the Magnificent Seven in America start to decline, which I think is imminent, then everything will come down somewhat. So I'm kind of holding off buying much more at the present time. I would like to buy when the conditions are better. But one thing I want to point out, the US has outperformed everything over the last 10 years. And some emerging markets and Europe have been trending down or are flat. And so some markets like the Magnificent Seven in the US, are topping out, whereas other markets are bottoming out. Also, food prices, many food prices, food commodities, wheat, corn, soybeans, are sort of bottoming out. And so I believe that money, once the Magnificent Seven and the FANG stocks in America, once they break down, the money will flow in other places. Also, once the dollar is no longer the favorite currency as it is now, the money will flow somewhere else and boost the prices of markets that have been in a downtrend for 10 years or so. So, for instance, I like Hong Kong shares and Hong Kong property stocks. I also like Chinese stocks. The Chinese stocks now are much, much cheaper than Indian stocks.
Interesting. But Mark, the chatter about the mighty IT giants in the US and, the big fall, or rather the impending fall, has been on for quite some time now. What makes you believe that, finally the Humpty Dumpty will fall?
Well, that's a very good question because you're never sure about predicting the future. I mean, I don't know any guru that predicts the future consistently, accurately. Especially foreign exchange markets are very tricky because they depend a lot on policy measures. But one thing I want to say about the Magnificent Seven in the US, they are extremely expensive, and they're expensive about relative to what you know with certainty about their future earnings. So on a PE basis, they're very expensive, and two, we don't know what the earnings of Tesla will be in 3 years' time. We don't know what the earnings of NVIDIA will be in 3 years' time or 5 years' time. So they are priced for a scenario where nothing goes wrong and everything exceeds expectations. And I don't believe that they will exceed expectations because if you look at statistics in America, investors' expectations are at the highest level ever. They've never been this optimistic about the future of stock prices. So I'm very skeptical, but I agree with you. You don't know for sure. But why take the risk about something when you don't know for sure? I'm more interested in things that are very depressed, where everybody's negative. In the Western press, you cannot find a positive article or comment about China and Hong Kong. And Hong Kong has its set of problems, but not as bad as Berlin, London, Paris, Marseille, and so forth, where the immigrants are taking over entire areas.
Is China the best tactical trade right now then?
I beg your pardon?
Is China then the best tactical trade because of the depressed valuations?
It's one option. Latin American markets are also very inexpensive. And in Latin America, last year, I was talking about Argentina for the last 3 years. Last year, it's the best performing ETF, up more than 60%. And some stocks within a year, like Banco Macro, are up 5 times. So you have to buy things that are really sold out and where nobody takes an interest. Stocks that are neglected, that is what you need to buy.
Quite interesting. Mark, let's talk about the India context because, clearly the dollar bullishness has weighed acutely heavily on our currency, and which is why you're also seeing this entire FII, FPI exodus. Along with that, of course, earnings as well have petered down, and it was a market which wasn't quite comfortable on the valuations, at least till October of last year. But where is it that you find structural stories now in India?
Well, as I said, I would wait to buy into India at the present time. I'm I'm of the view that the global markets are not particularly attractive because we have a scenario where interest rates are likely to move up in the future because they haven't addressed in the Western world the problems of inflation. The problem of inflation arises from too much government spending, which then has to be financed by money printing, by an expansion of money in the system. And that creates inflation. And everywhere in the Western world, the debt level, the government debt level has increased as a percent of GDP, especially in the US and so forth. So in my view, the entire environment for stocks is not particularly good. Number two, I believe that commodity prices are sort of bottoming out. Maybe gold is not bottoming out here because it's relatively high, but say other commodities, food commodities, are sort of bottoming out and could increase quite a lot in 2025. So if that happens, inflation will accelerate. And by the way, I want to emphasize this to Indian viewers. The inflation rate in America, and I define inflation here as consumer price inflation, not asset inflation, but the increase in the cost of living, that is inflation. The increase in the cost of living in America is, of course, not 2.3% or 2.7%. It is much higher. It is between 7 and 10% if it's measured properly by private institutions and not by the government. The governments, all of them worldwide, have one leisure time activity, and that is to lie to the public about everything. They never tell the truth. And inflation, I guarantee you, you can ask every Indian, how much is the cost of living or your cost of living going up? You can ask any American, you can ask any European, how much is the cost of living of your family going up? It's all above 5%, not what the government is telling you.
Fair point. You do feel the pinch on an everyday basis because the cost of living seems to have gone up much higher than just around 5%. But Mark, since you are the author of the Gloom, Boom and Doom report, tell me, where is it that you're seeing a gloom? Where are you seeing the boom? And which is that doom area?
Well, the gloom and doom is, in my view, the popular American stocks where everybody's speculating at the present time. The most widely held stocks by the public in America are Tesla and Nvidia, both highly priced stocks with an uncertain future. And these stocks, people trade them from all over the world. So that is a sector I would avoid. And we have examples. 2 years ago, in 2021-22, we had the SPACs stocks, which were popular, then the meme stocks, and so forth. And all these stocks are down significantly. 4 years ago, the most popular stocks were cannabis stocks. They're all down 90%, and most of them are actually bankrupt. So stay away from very popular sectors. That's my view.
From the popular sectors, that's a view coming in, Mark. And we just have that big event lined up in India, the union budget. Are you expecting the government to come out with some big bang announcements? Or do you think that, in order to put more money in hands of consumers, the cost of living topic that we just discussed, they should come out with some sort of tax rebates or subsidies?
I'm in favor of tax rebates, and I'm also in favor of reducing the government. In a perfect society, the government is maximum 15% of the economy and no more. And the government should stay out of the economy entirely, because whatever they touch, the government does worse than the private sector.
other thing I wanted to talk about, you were touching upon commodities and you did talk about agri. What about the precious metals? Do you think gold and silver will continue to have the bull run that they have cherished for a large part from the COVID lows?
As you know, I have been optimistic, or not optimistic, I've been pessimistic about paper money for the last 40 years. And I've always told every reader of mine and viewer of interviews and so forth, if you trust central banks, then keep your money in paper money. But I will never trust the central banker because all of them print money. And so the value of paper money is going down. It's going down in India, it's going down in America and in Europe. And the anchor, what is solid, is the price of gold. The price of gold doesn't move up, but the value of paper money goes down. So expressed in paper money, the gold price looks as if it's going up. And I would hold some gold as a reserve. I don't speculate in gold. But last year was a good year for me because the value of paper money has gone down 30% compared to gold. So to your viewers, I would advise keep your gold, but make sure that the government doesn't touch it because that is always an issue. They can also touch your big bitcoins and other cryptocurrencies, that I tell you.
Yeah, we'll have to be careful of that. But Mark, always a pleasure speaking with you. Thanks so much for joining us today.
Well, it's my pleasure. Thank you very much. And I wish you viewers a successful 2025. But I think the volatility will be very high.
Yeah.
So you have to be careful in your investments.
Be careful in your investments. Volatility is going to be high. That's the sage advice coming in from Mark Faber. But shifting focus back to the Indian markets, the point that Mark was also making, that just stay away from popular sectors. Does that make sense here in India as well? Or do you think momentum is the place to be in?
I don't think that the momentum will permanently continue. Momentum has typical habit of shifting from one to another. So certainly, I think you can't be, continuing with the momentum the way it has been happening in the last few quarters. For me, I think it makes sense for the last so many years, and decades we have been invested in the markets. It makes sense to stay with the quality fundamentals. You can't be chasing the values, which are far too expensive. If you do that, probably underperformance is guaranteed. And that's where probably one should be wary about, one should be careful about. Fortunately for India as a country, the opportunity size is growing big time. And fortunately, some of the large cap companies which are party to make it happen, they are available at a valuation which is far more inexpensive compared to their peers in mid cap and small caps who are extremely expensive. So given that kind of a situation where you have to buy margin of safety, some of the large cap companies which are relatively traded at an inexpensive valuation, sub 20 price earning ratio in Nifty 50 case, I believe that they are the ones which will provide a margin of safety. And whenever there is an improvement in the sentiment in the market, they would be the ones who should be taking the lead in producing better returns. So one will have to play safe in this kind of environment without getting any fear or at the same time exuberant about the subjects.
Very interesting. So Devin, the strategy is just to stay put, start hunting, or not quite?
No, certainly. This market is offering a good amount of opportunities. The corrected price levels in some of the companies where the business fundamentals are strong, they are absolutely very convincing. Maybe after buying, you may have to wait for 3-6 months before which it starts producing the return for you. But that's okay because they are in a long-term investing game. So obviously, this kind of corrective downside is an opportunity to buy in a portfolio.
Great to have you, Devin, today on the show. Thank you so much for your time.
Thank you.
Okay, let's just revisit where the market is settling in at. Less than half an hour to go before we wind up for the day, and it's still bleeding. We're now 300 points lower. So if you thought the selling is going to abate anytime soon, the market is really in a hurry to perhaps book all of the losses today itself. Trent is now down 6%. Adani Ports, NTPC, ICICI Bank has cracked 3%. SBI is down 2.5%. BEL is down about 2.5% as we speak right now. Reliance down 2.5%. I can just go on with the list of losers because the sectoral damage as well has been quite stark. Realty, New Age, cap goods, telecom, power, finance, technology, automobiles. There's not one sector which is in the green as we speak right now. We'll continue tracking markets, but after this very short break.
So that level of 23,047, which was expected to be a very strong marker, has been broken. In fact, we went below the mark of 23,000 on an intraday basis. For now, we're managing to hold on to 23,000, but anything can happen in the last 15 minutes of the trading session because the Bank Nifty, of course, is under pressure. Sensex is down a solid 1,200 points, and the broader markets are also bleeding as we speak. The small cap index is down over 2.25%. Mid cap index is coming under pressure. It's not looking a very pretty screen at this point of time, and this is despite the global cues being okay. Of course, the US markets were shut yesterday, but if you look at the futures market right now, there's a bit of a green on the screen as far as the US futures is concerned. Dow is expected to be up around 150 points. Nasdaq futures are looking healthy. So not pressure coming in from the global screens, but it is our market which is perhaps tumbling under its own pressure. Kunal, you're talking about 23,050 being an important mark for the index. It's broken. If we end below that mark, are we headed to 22,800 then?
Yeah, I think 22,800 could be a normal day for the index, 200 points on the intraday basis. I think what matters now is because the India VIX is at 17 to 18 mark, and assuming if the India VIX crosses those levels of 18 also, the range for the index would start to broaden, because when you see the index moving on a high VIX note or a high India VIX note, the range is not a usual 0.81%. It generally expands to 1.5 to 2% at least. So which means that the next support below the 23,000 mark, if we close below this level, should be at 22,500 for the index.
Okay, that's that on the index right now. The fall continues. Zomato now down over 11%. Dixon headed in for a near about 15% decline. There's MCX down 8.5%. Kalyan Jewelers in any case has been beaten down. That's a different story altogether. Another 7% lower for that stock too. Oberoi Realty too taking quite a bit of knock. That stock too down about almost 8% as we speak. Geo Financials 6% lower. Idea down 6%. Policy Bazaar down 6%. Trent, Prestige, Lodha, the realty names and one of the best performing indexes of the year gone by. They're the ones which are really taking it hard. CDSL, CAMS, Paytm, Coforge, Indian Hotels down 4%, Delivery down about almost 4%. And it's, all those other than real estate, the new age names, they are the ones which are really getting clobbered down. Besides, of course, some of the blue chips of the bluest chips, they're the ones also like an ICICI Bank, Indian Hotels, Trent, which has also been consistently seeing a sell-off for the past many trading sessions now. But Ajay Bagga too on the show with us. Ajay, hi, afternoon. What is it that you're making of this free fall in the market? It's almost smacking of capital protection. And, I'm sure viewers are wondering whether or not to at least book out their gains.
Well, I would say if you believe in the India story on a 2-year, 4-year, 6-year basis, we are still looking very good. Right now, there is a huge change in global politics, global messaging. And Trump, by design, practices indisciplined messaging. So today also, Aisha, if you see the day, the morning started well, the dollar was down 1%, dollar index was down 1% at the start of the US day. And then in the Oval Room, while signing some agreements, a journalist asked him about tariffs. And then he held forth that maybe we'll put 25% on Canada and Mexico. Maybe we'll do it on 1st February. And that's where the markets then took a swing back. So this markets over the last 4 years had become used to leaders talking within guardrails. Now we have a leader whose method is madness. So you are going to see a lot of irrational commentary, which might not get followed through. Today, if you see out of the 100 odd executive orders. There is nothing on tariffs, but there is a lot which is very positive for markets, like the deregulation, like looking at all the federal expenditure. A lot of things which are good for the markets were also done, apart from the usual politics that comes in on inauguration day. That has got missed out in all this talk of tariffs. But we must remind, and I addressed about 6 conference calls today, and my only point consistently was that the guardrails for Trump are a strong economy and great performing markets. He is a markets person, end of the day, and but his negotiation style is Richard Nixon of the leader as a madman. You create a negotiating space by throwing out irrational rhetoric like 100% tariffs on BRICS. And unfortunately, he didn't know that the S in BRICS stands for South Africa and not Spain. He kept telling the journalists, and nobody had the guts to tell him. He kept saying, you know what is BRICS, you know what is BRICS. So if Spain does this, I'm going to put 100% tariff. Spain doesn't even count in the trade with the US. So that is what was going on. But the markets have chosen that A, he'll follow through on tariffs, and B, they have said that sell now and ask questions later. So that's what we are seeing. Unfortunately, it has to be gone through. Nothing India specific apart from our slow economy, slowing earnings, and a little bit of policy spend not going through last year and hopefully picking up next year. Nothing has changed in the India macro to see this kind of 2% sell-off today. But that is par for the course. You have to take it when you are globally linked in.
Fair point. Madness indeed, but the big question is there going to be some method to that madness is what the market really wants to know. But India's largest private transmission and distribution company, Adani Energy Solutions, has won a 25,000 crore high voltage direct current order in Rajasthan and Uttar Pradesh, making it the company's largest order till date. This will boost its order book under execution to almost 55,000 crore rupees. The project will help evacuate 6 gigawatt of renewable energy from various renewable energy zones in Rajasthan to demand centers across North India as well as the national grid. The company is expected to deliver the project in 4.5 years, and that is of course going to change the landscape of the energy system in northern India with that large setup of power coming in. So that's the latest on the Adani group of stocks, but let me take it across to Naresh as well. Naresh, within the pack, is there anything which looks like a buy?
In the Adani's bet, nothing as such.
Nothing from the Adani group that looks interesting at this point of time, but just taking stock of what is happening in the market right now. Are we holding on to 23,000? Yes, for now, 23,035 is the level. Trend is down 6%. Adani Ports, NTPC, ICICI Bank, SBI. These are the ones which are bleeding in the trading session. From the broader markets, it's MCX which is down 9%. Keynes, Kalyan, India Cement, some of these names are also in the red. What's the sense on this entire EMS pack, Naresh? Dixon, of course, is an earnings reaction, but Keynes is also down 10%. You're getting a Sirma SGS also in a fire sale, which is down almost 6%. Is this the time to perhaps buy any of these names? Amber Enterprises too, down 8%.
So this could be a time to actually exit on every rise going forward. This has been a sector which has been overrun. There has been a parabolic move. Most of the namesake Keynes has gone up from 1,500 all the way to 7,500 over the last 2 years. Same is the case. We've seen a 3x, 5x move in most of these names. They're overvalued on a lot of parameters, and they're overowned in terms of participation by institutions. And when such stocks fall 20, 30%, they could remain sideways and stay there for a long time, and every rise will continue to see selling pressure. So the view is sell on rise rather than buy on the dips.
What is it that you're making of some of these names? I mean, a slight earning miss, but because of the bloated valuations, you're seeing such exaggerated reactions on the stock. I mean, a case in point being Dixon and the kind of rub-off that it's having on the rest of the sector as well. A buying opportunity just yet, you think, or would you say wait it out?
Aisha, is that for me?
Yes, for you, Ajay.
Sorry, the connection went off in the beginning. Yeah, overall, if you see this EMS space, Aisha, it is a low-tech space of putting together, assembling electronics and exporting it out. Very good business at scale, but the margins are very low. The fear is that there is very low competitive moats in that the next competitor can also scale up very rapidly, and the valuations don't justify. And the globally also, you don't get 100 times P's for companies like this, or 100 times forward P's. So this had become something like our defense or railway story of last May, June, when we started saying these valuations are looking too high, and then we know what happened over the last 6 months. So EMS also to some extent was a victim of its own growth, where the market has had become too exuberant. So unless they are growing at this kind of a rate where they double every 3 years their earnings spot, you can't justify these kind of valuations, and that's what's catching up with them. I would say stay away. And if you're holding, then know that you should hold for the next 4 or 5 years. Then you should be okay as the earnings catch up to the valuations. But the next 1 or 2 years, the price recovery could be quite slow. That's where we are at. And overall, the global trade is getting hit by protectionism. Of course, there will be pockets like EMS has been for India, where we'll be beneficiaries. We'll take out business from the Chinese. But you have to keep seeing what are you paying for. So if you're paying a very high price, then you have to justify it with very strong growth, which despite the kind of growth they have done, it's not looking justified now on the present results. That's why you're seeing these sharp falls. And that's why Nuresh said that maybe sell on every rise, or you hold for a very long period, 2 to 4 years, it will get justified.
Fair point.
But right now, looking back.
Yeah, so at least perhaps they've peaked in the very, very near term. That's the view on some of these EMS companies. But come tomorrow, the spotlight will also be on HDFC Bank as well as HUL and BPCL, which will be coming out with earnings. HDFC Bank, remember, came out with a provisional set of data which was weaker than expected. And hence, there is that chatter on the street that maybe the NIMs are going to be on the weaker side as well. We could probably take it across to Gaurav, who will be joining us to talk to us about what the expectations are. Gaurav, run us through what are the numbers that the street is penciling in for HDFC Bank come tomorrow.
Well, yes. When we look at HDFC Bank's pre-quarterly updates, we have already seen that loan book growth was at 3% on a year-on-year basis. But let's not forget that within that, corporate and other wholesales grew almost by 2.8% on a sequential basis. When we talk about deposits, we saw a growth of around 16%. But even within that, CASA degrew almost by 1.3% on a sequential basis. And now with this, brokerages flagged off that we may see some pressure on net interest margins because of the high bulk and term deposits, and at the same time, higher sequential growth in wholesale banking. With this, when we talk about numbers, now brokerages are expecting net interest income to increase almost by 8%, while PPOP and PAT can increase at a rate of around 5% on a year-on-year basis. We may see some moderation in net interest margins, but they're not expecting a big moderation. They're expecting 1 to 2 basis points of moderation on a sequential basis. On the other hand, when we talk about asset quality, they're not expecting any kind of concerns from HDFC Bank. They're expecting credit cost to remain somewhere in the range of 0.5%, while cost to income ratio can moderate, which can support PPOP growth. On the other hand, any kind of commentary on net interest margins is going to be a key thing to watch out for. And at the same time, gross slippages are expected to rise, but any kind of commentary on the asset quality side is also going to be something important in this quarter because of the agri stress which we see in Q3. But definitely, all in all, good set of numbers are expected from HDFC Bank with focus more on net interest margins in this quarter.
Well, yes, all eyes are going to be on Nifty 50 FMCG major HUL's Q3 earnings. If you take a look at these numbers on a standalone year-on-year basis, revenue is seen at 15,735 crores, which is up 3.6% year-on-year. EBITDA is seen at 3,661 crores, which is up 3.4%. PAT, we're expecting this number to come around 2,634 crore rupees compared to 2,500 crores last year, which is up 4.6% on a year-on-year basis. EBITDA margins are expected to see some sort of a pressure coming in at 23% compared to 23.3%. Now, EBITDA margins we're expecting to be under pressure due to the 25 bips hike in the royalty that it gives to the parent and adverse operating leverage. Raw material inflation could be weighing on margins as well. So that is why we're expecting some sort of pressure building up on the EBITDA margins in Q3. Revenue growth is to be driven largely by home categories. BPC revenue growth of 2.7% on the back of the pricing action that the company has undertaken. So we're expecting beauty and personal care to do well this time. Food and refreshments is expected to grow at 2% on a year-on-year basis. However, when you take a look at the underlying volume growth, that's expected to be only at 1% on the back of weak urban demand. So this is something that could ail HUL's Q3 numbers. Some key monitorables when the numbers come out, the consumer response to the new formulation of the Lux and the Lifebuoy soaps that the company has undertaken. Demand outlook on rural versus urban demand, competitive intensity, raw material inflation, and the outlook on where they think input cost prices are headed and how long before it eases. And lastly, pricing action is also going to be something to watch out for. But overall, we're expecting a rather decent set of numbers coming in for HUL for Q3.
Okay, that's the expectation from both HDFC Bank and Unilever. But thank all of our experts for joining in today, Ajay, Kunal, as well as Naresh. And I'm going to hand it over once again back to Snehi to wind up this extremely painful day that the equity markets have had.
Asha, absolutely, that sums it up. Extremely painful is the kind of day that we've seen today. A 310-point cut coming in on our Nifty 50 index today, a 1.3% cut and 1.7% cut from the day's highest point is where Nifty is barely struggling to hold on to the 23,000 mark. Remember, at one point in the day, we did slip below the 23,000 mark, close to 22,950, 970 levels. But once again, we are above the 23,000 mark, so well, that's something to be happy about right now. Sensex also lower by 1.5%. A 1,000-point cut coming in fact 1,100-point cut coming in on an intraday basis when it comes to the Sensex. Broader markets also taking it steeper on the chin. It's a big cut coming in over there as well. 2.5% lowers of the Nifty mid-cap indexes. Another 2.5% lowers of the small-cap indexes right now as well. A 400-point cut on that index as well. Advanced decline ratio very steeply in the favor of the declines today. On the back of that, India Wix was also up and away in today's trading session. As high as 6 or 7%, has cooled off slightly and it is at a 4% uptick when it comes to the India Wix. A couple of stocks that were in focus today. Zomato continues the second day in the red. Big tumble coming in on Zomato on the back of pessimistic brokerage notes coming in. Swiggy also had a spillover effect from Zomato, was collateral damage rather, and Swiggy was also lower by roughly 10% in today's trading session. Dixon Tech then 13.5% lower is where that stock was because the PAT has missed street estimates. Vodafone Idea was down roughly 5% because the company has issued clarification saying that they have no update from the government on the waiving off of the AGR due. So that stock also lower by almost 6%. Oberoi Realty pre-sales was lower, missed street estimates on the back of that update. 8% lower is where Oberoi Realty is closing for the day. Aavas Financiers, however, on the back of a bullish brokerage note coming in from Citi, wherein they've maintained a buy rating, target price of 2,170 rupees. On the back of that note, Aavas Financiers managed to hold up its own 2% uptick coming in on Aavas on the back of a sideways market like this. Overall, if you take a look at some sectoral gainers and losers in today's trade, all sectors have ended in the red. At one point, you did have the FMCG sector holding up in the green, but nonetheless, that has also slipped towards the red. Realty is your biggest loser, obviously dragged by Oberoi Realty, followed by Energy, PSU Banks, Auto, Nifty Bank, Pharma, IT, Metal, FMCG. This is your pecking order from most to the least sectoral losers in today's trading session. But that's how we are shutting shop for the day. A 290-point cut coming in on the Nifty above the 23,000 mark for now. Let's hope for a better trading session tomorrow.